Firefly just crossed $100 million in quarterly revenue for the first time. But the number investors need to watch is not the headline beat. It is the distance between a $1.5 billion backlog and the cash required to turn that backlog into launches, lunar missions, and defense systems. Revenue reached $117.7 million in the second quarter, up 659% from a year earlier and 45.5% from the prior quarter. Firefly reiterated full-year 2026 revenue guidance of $420 million to $450 million. That sounds like a clean acceleration story. It is not clean yet. The same quarter produced a $92.3 million GAAP net loss and a $106.3 million free cash flow outflow, and Firefly now expects 3 alpha launches in 2026 instead of 4, with Flight 8 pushed to the fourth quarter. This is the investor contradiction. Demand is strong, but production and cash conversion are still being tested. Nothing in this video is financial advice. This is for educational and entertainment purposes only. Firefly is interesting because it is no longer one bet. It is a stack. Blue Ghost lunar landers, Elytra spacecraft, Alpha small launch, Eclipse medium lift, Forge software, and defense work. The potential is a broader space and defense platform. The risk is that each layer needs capital and execution before it becomes a durable margin stream. The fresh earnings report gives investors a better checklist than a launch photo. Ask how much of the $420 million to $450 million guide is already booked, when backlog becomes revenue, which programs carry the best gross margin, and what the next alpha flight actually requires in cash and schedule. The broader space market makes this more important. SpaceX and the SPCYX complex have pulled attention toward the largest private platform. A smaller public name like Firefly has to earn a premium through execution, not simply through exposure to the theme. Start with the revenue mix. Spacecraft generated $108.3 million in the quarter. Launch contributed $9.4 million. That tells you the current Firefly business is being carried by spacecraft programs and milestone work, not by a high-frequency alpha launch machine. That is not automatically bad. Spacecraft contracts can create a steadier milestone cadence while alpha is still ramping, but it changes the way you value the company. The launch narrative is visually powerful. The reported revenue engine is currently more spacecraft-heavy. The backlog reached approximately $1.5 billion, up from $1.3 billion in the prior quarter. Management said roughly 95% of the midpoint of 2026 guidance is already booked. Backlog is evidence of demand. It is not cash in the bank, and it is not the same as recognized revenue. The bridge matters because Firefly recognizes different work in different ways. Alpha revenue is recognized when a launch occurs. Eclipse revenue is recognized over time based on program milestones while it is being developed with Northrop Grumman. Spacecraft work also moves through contract milestones. The timing of those milestones can make a corner look very different from the underlying demand. Now the alpha schedule. Firefly is targeting 3 launches in 2026, including Flight 8 and Flight 9. Flight 8 is in integration and test, with acceptance testing, delivery to Vandenberg, static fire, payload integration, and range coordination still ahead. Those are real steps. They are also a long chain where timing can move. The company says demand is not the problem. The majority of Alpha's 2027 manifest is sold. Flights 10 and 11 are already flowing through production.
Firefly is adding a second launch pad at Wallops in 2027 and targeting Sweden no earlier than 2028. Capacity is being built for higher cadence, but the market will want proof that production can scale without expanding losses faster than revenue. Eclipse is the other major launch option. Its Miranda engine has passed 150 hot fire tests, including a flight-like mission duty cycle test lasting 226 seconds. Northrop Grumman is a serious development partner, and Firefly expects first-stage delivery next year, with an inaugural launch no earlier than 2027. That is valuable optionality. It is not current launch revenue. The same logic applies to the lunar business. Firefly now has 6 contracted lunar missions, including a $144 million NASA CLPS award for a rapid Blue Ghost follow-on mission. Blue Ghost Mission 1 proved that a commercial lander can reach the lunar surface and complete operations. The investment question is whether missions become repeatable program revenue rather than isolated milestones. The opportunity is a platform moving from milestones to throughput. If spacecraft launch, lunar, and defense programs share manufacturing, software, and customer relationships, Firefly can grow faster than any one product line. The SpaceAng acquisition adds AI-powered vision navigation and autonomous guidance. That could strengthen vertical integration across missions. But platform stories only become investable when the economics show up. The first question is revenue quality. With spacecraft at $108.3 million of Q2 revenue and launch at $9.4 million, watch whether launch becomes a larger and more repeatable contributor or remains episodic. The second question is margin. Firefly reported second quarter GAAP gross margin of 20.3%, down from 21.6% in the first quarter, partly because of forged hardware purchases. A growing backlog with thin or volatile margin is less valuable than a smaller backlog with predictable contribution profit. The third question is cash. Firefly ended the quarter with total liquidity of $940.3 million, including $635.3 million in cash and short-term investments, plus $305 million of undrawn revolver capacity. That gives the company room to execute, but it does not eliminate financing risk. Free cash flow was negative $106.3 million, and the company raised about $181.6 million net in a common stock offering. The fourth question is contract quality. The $94 million Space Force Ground-Based Radar Digitization Award, the $75 million Moonfall subcontract, the $13 million Mars Aeroshell subcontract, and the Lockheed Martin extension for up to 25 Alpha launches through 2031 expand the story. They also create delivery obligations across different timelines. Investors need the milestones, not only the award total. The fifth question is valuation. The fresh chart shows Firefly bouncing from its recent lows, while analyst pages show a wide range of expectations. A rebound can be justified if execution improves. But a higher price also raises the cost of every miss. A delayed launch, a weaker margin, or a cash need can reset the multiple quickly. The trade is not simply bullish or bearish. The bull case is a booked revenue base, a backlog that keeps expanding, multiple government and commercial customers, and a production system preparing for more launch cadence. The bear case is that revenue is milestone heavy, cash burn stays elevated, and the alpha schedule slips faster than operating leverage arrives. Risk 1 is schedule compression. Cutting the 2026 Alpha plan from 4 launches to 3 may be a sequencing issue.
It may also show that the production system is earlier in its ramp than the backlog suggests. Flight 8 in Q4 is a catalyst, but it is not a guarantee. Risk 2 is execution across programs. Firefly is developing landers, spacecraft, small launch, medium lift, defense software, and autonomy. Diversification can reduce dependence on one product. It can also spread engineering and management attention thin. Risk 3 is cash conversion. A $1.5 billion backlog can still require years of spending before revenue is recognized. Milestone payments help, but investors should track operating cash flow, capital expenditures, acquisition payments, and stock issuance together. Risk 4 is customer and government timing. NASA, Space Force, Lockheed Martin, Northrop Grumman, launch ranges, regulators, and weather all influence the calendar. These relationships are strengths, but they're not fully under Firefly's control. Risk 5 is expectation. The 659% growth number is real. It is also measured against a small prior year base. Investors should keep the percentage beside the absolute revenue, the cash outflow, and the margin. Firefly represents a broader shift in space investing. The winners may not be the companies with the most dramatic mission footage. They may be the ones that turn government demand and commercial contracts into repeatable production, then into cash flow. The near-term scorecard is straightforward. Does Flight 8 move through integration toward launch? Do spacecraft milestones convert the backlog into the guided revenue range? Does gross margin stabilize as forge purchases roll through? And can cash use moderate as scale increases? If the answers improve together, Firefly can look less like a collection of space projects and more like a scaled platform. If revenue grows while cash burn and schedule risks stay elevated, the market may keep treating the stock as a high potential but high financing risk story. So the clean takeaway is this: Firefly beat on revenue, but the investment case now depends on conversion. Watch backlog quality, alpha cadence, gross margin, and free cash flow together. One good quarter does not remove the execution test. Tell me which metric you would demand before calling this a durable space platform: launch cadence, margin, or cash flow. Follow Launch Money TV for the next space stock update. Nothing in this video is financial advice. This is for educational and entertainment purposes only. Do your own research.